Done.
Okay, what we have up here is the general market indicators page from this week's newspaper. And I'm bringing your attention to these high spike red bars. And the first one here is back in December of last year. The next one we have was in March. The next one we have is in June. And then this one was from Friday. So what do all of those big bars have in common? It was quadruple witching for every single one of those big bars. So, and the same thing was true, if you look at what happened with the NASDAQ, we had those big spikes as well. So, moral of the story here is be careful around triple witching because the market, is not going to be very strong during that period of time. And if we actually go to the next slide, okay, it says, why was Friday a bad market day? On June 16th of 2022, that was the first quadruple witching. And we were down the next day as well, and the market was down 2 days prior to that. So we actually had 4 down days. The next time we had quadruple witching was Friday, March the 17th. We were up the next day, and the market was up the prior day. Now, the market is usually stronger during this time frame. That's why we had more days that were up. In the December time frame, we have tax loss selling at the end of the year. And usually the market is not especially strong from December 16th on because of tax selling. It picks up again in January, especially because we start having earnings reports in January. So that takes us then to the June time frame. And June time frame was Friday, June 16th, and we were down the next day. The market was up slightly the day before, but it was down for 4 days prior to that. So again, this was not necessarily a strong time frame. Remember, the sell in May and go away. The market was pulling back at that point in time. So that brings us to this Friday, which was September the 15th. And I expected that today would be a down day. And while it wasn't in the red, it certainly wasn't very markedly in the green either. I mean, none of the markets were up substantially, not even 1/10 of 1%. So, you can't do much when the market is not going to work along with us. So the things to remember for this week is that we have the Fed meeting this week, and so that is going to put a damper on the market as well. So moving on to the next slide, we're going to be looking at the performance of ETFs for the last week. And I am now responsible for an ETF group with Ajit Desai in California. And we have 50 members. So we got these members all in 1 week. We have not added any additional members since then. And we had one person drop out because they were not able to continue to participate. So this is a report that one of the people in the back testing group is putting together, and he uses a black box system called Garch, G-A-R-C-H. You can look up Garch, if you Google it, and it'll give you some information. It was a system he originally paid for, and then what he did was he took some of the things from that and he programmed it into another program which he is now using to give him basically the same information. So I gave him 130 some ETFs that on a weekly basis he is running this report for me, and then he says when was the first buy for any of these and when was the first sell. he gives a buy above or a sell below. So if this was the buy at 152.53, the sell was at 149.31. And this was one that was a sell at 47.12, and you would buy it if it went above 48.81. This is telling you how many days it has been since the buy or sell signal. And what I did for my group, but it is not here, is I actually showed what that particular date was so that you could look at the chart and say, okay, well, what was that ETF doing at that point in time that made it a buy or sell? So this was from Friday's close. And what you can do is look 13 days back, 13 trading days, not 13 calendar days, and you will see what QQQQM was doing at that point in time. And, it goes down and down. And if you go further down on the list, if you pan down the list, one of the things that we will see is that there were, 3 days ago, we got the TZA, which is the small cap bear 3 times. We got TNA, which is the small cap bull 3 times short. So what are we seeing here? What we're seeing here is that the market is not strong because what is outperforming are the short stocks, the short ETFs. So a word to the wise. So this is something that is going to be produced on a weekly basis, and I will share this with you in the future, and we'll see what happens. There is more interest in the leverage ETFs as opposed to the non-leverage, but in this particular grouping of 136 ETFs, I put a smattering of both the inverse as well as the leveraged ETFs as well as non-leveraged ETFs so that we could, sort of see what's playing out in the market at this point in time. So that's all I have to say about this particular slide. Moving on to the next one. Okay. This particular group has several different things that they are responsible for. And one thing that they're responsible for is the country funds. One of the things I thought would work is if we put them by relative strength. However, they don't necessarily always work the best if you just pull them by relative strength. When the market is strong, you will see that the top 5 performing ETFs on the ETF table are those that have the highest relative strength. However, when the market is not outperforming, what we're finding is that the ones that are outperforming have a relative strength of 30 or less, sometimes down as low as 3. So I can't say that relative strength is going to be all end all for this particular group. So we're looking at other possibilities of things that we could use that are going to help us find what is going to work out best for us. So there are some additional slides that we could look at. The next slide in that group. Okay, this is looking at internationals. So this is looking at the top relative strength by international, and you can see that this one had a change of 2.3%. These are a little lower down in the 70s, but they had 2.8, 2.46, 2.35. That's in the lower 70s. And I said we really shouldn't be looking at those that are under 70 for relative strength. And lo and behold, the one that's a 70 for relative strength had the best 1-week return of 2.99%, and that happened to be the LVHI Franklin International Low Volatility High Dividend. So moving on to the next slide. This one is looking at the global ETFs, and there were 5 that were above 70 for relative strength. And in fact, those had the best returns, 1.74, 1.19. This one was 63 and 63, 1.27, 1.19 for the week. This one was further down. It was a 49 for relative strength, which happened to be the Flex Stocks Global Broad, and it was up 1.79%. And this one had a return of 2.07, iShares Global International. So, just to give you a flavor for where things are going. Now, with the dollar, you really need to look at what the dollar's doing in terms of what's happening with the global and the international, because the dollar has a strong influence on where those types of stocks are moving. Moving on to the next one. Okay, this is looking at emerging markets, and none of the emerging markets did well. 1.19, 1.12, and those were the ones that were above 70 for relative strength, but some of the other categories seemed to do a little bit better than the emerging markets did. And that 1.19 was the dimensional emerging markets sustained core group 1, DFSL is the symbol. Okay, moving on. What we have here is a sector rotation model. And this was something that was in a Fidelity newsletter many, many years ago. And actually, I got it out of the tombs of my emails and found it. And I thought it was interesting because what it does is it tells you what segment we are in terms of the market, and it tells you what types of stocks outperform. So this is showing when you're in a full recession and at a market bottom, which we are not at this point in time. And the stocks that performed the best during that period of time would have been technology and discretionary. And if you think about it, technology goes up the most and the quickest when we're at a bottom of the market, but it comes down the fastest when we're at the bottom. So the next stage that we have is early recovery, and we're in a bull market at that point in time, and commercial services and industrials perform well at that point in time. And a little further into that, we see materials and energy. Surprise, surprise. Guess what's outperforming now? Materials and energy. So what is the next group that then outperforms? We have consumer staples and healthcare when we're in a full recovery mode, and we're not there, and I don't know if we're going to get there, but if we're going to get there, it likely will start in October. And after that point in time, what we see that outperforms is utilities and financials. Utilities are the last position in the 33 sectors in IBD. And then we also have real estate. So again, this slide will be available for you, and it tells you what's happening at that point in time. It tells you whether interest rates are falling or bottoming or peaking or what's happening with the yield curve, etc. So I thought this was worthwhile for you to look at. So the next thing we have here is something that I put together with a friend, and Roger was giving his presentation previously on where we were in terms of the percent of stocks above the 200-day moving average, et cetera, et cetera. And I do have something that we just put together over the weekend so that we would be able to do that. But what this does is it takes the sectors and we're stacking them. Are we above the 5-day moving average? Are we above the 10-day, the 21-day, the 50-day, the 200-day? And you can see that XLF and XLE are above those time frames, and those are the two best performing sectors. And we saw that when Keith showed the RRG charts. So I'm going to continue to use this on an ongoing basis because it's a real simple way to say what is outperforming and what is not. So this is showing that these are above the 200-day moving average, but they're under all of the others. So these are not going to be outperforming for a while, and the S&P is in that group because the S&P is now below the 50 going towards the 200-day, still above the 200-day, but not going in the right direction. We need to have greens going from right to left. So that's all I'm going to say about this one. So now we're going to look at something that was posted in IBD a while ago. And the reason I put this here is because, you know, we show the ABCDEs all the time, and I don't know if anybody really knows why they're worthwhile. But this was actually in the newspaper in 2019. And it said that in the movie All the President's Men, Deep Throat tells Washington Post reporter Bob Woodward to follow the money to solve the Watergate mystery. Same advice applies to investors seeking to master the techniques of how to find the best growth stocks about to break out. Winning stocks typically start rising in heavy volume before they move to new highs. Strong volume increase signals that mutual funds and other big funds are actively taking positions. It usually takes such investors weeks or even months to accumulate the many thousand or even millions of shares they need to fill their positions. This activity will be reflected in the IBD's proprietary accumulation distribution ratings, which analyzes the stock's price and volume trends over the past 13 weeks. So, a rating of A or B indicates that the funds are buying or accumulating. The stock accumulating the stock. A C rating is neutral. It's neither going up or down. It's just hanging tight there. And a D or E indicates net selling or distribution. We have the IBD 6000, and the IBD 6000 takes all of those stocks, gives them a letter rating, and then we see what the market's doing in relationship to the number of A's and B's there are, or C's or D's or E's. So look at a stock's daily and weekly chart to see if the stock is rising in heavy volume. On breakout days, the volume should be more than 40% above average, indicating big fund buying. You can confirm that action against the accumulation rating too. The accumulation distribution rating appears in the IBD daily stocks research tables at Stock Checkup at investors.com and in charts accompanying the IBD 50 and the Big Cap 20. IBD takes go to research section at investors.com to see both the daily and the weekly charts and the Stock Checkup to see all the stocks' key proprietary ratings for IBD. So how to find the best growth stocks? As easy as A to E. Use the A to D rating along with other tools before buying any stock. These include the stock's composite rating, which combines major IBD proprietary ratings into one, including the accumulation rating, the earnings per share rating, and the relative strength. The table included with the story shows the accumulation distribution rating of stocks that traded near buy points back in February of 2012. Their composites and relative price strength ratings are also provided, along with their percentage difference off the 52-week highs. As always, make sure the overall market is in a confirmed uptrend. We are not in a confirmed uptrend. We are under pressure, and that the stock is at a buy point in a properly formed base before jumping in. Also, don't wait for the AD rating to fall to D or E before selling. Look at the stock's daily and weekly chart action before deciding whether to hold or sell. Pullbacks in below average volume usually aren't a concern, but heavy volume drops could mean the institutional investors are bailing out. The slides are not here because they were too old and I didn't think they would be worthwhile for us to see. Moving on to the ABCDs. Okay, so you can see that there's a lot of colors in here. A lot of colors. Go all the way up to the top. If we could go to the top of the slide. Okay, so this starts out at the beginning of the year, and it shows the A's, B's, C's, D's, E's, what the S&P rating is, the NASDAQ, the Dow, the percentage of stocks above the 200-day moving average, adding the A's and B's together, the C's and D's together. I have always said A's and B's have to be a higher percentage than C's and D's. When they are not, you get a negative number. You want this to be the biggest positive number it possibly can be. And this is totaling up all of the stocks in the IBD 6,000, and you can see that there are more than 6,000. It was named that when they first put it into practice, but now there are more stocks that are being traded, so that's why that has changed. So you'll see that we were in the red here because the percentage of stocks above the 200-day moving average were below 50. It is not a good time for you to be buying in the market when we are below 50. But here we are on 111. We are in an uptrend, and we are now up to 53. You can see that if you look at the number of A's and B's, that number is a higher number, and we are positive in terms of the A's and B's minus the C's and D's. And if you look at the percentage of A's and B's, we went from 40s to now a positive number of 51.2. That is another thing that you want to look for, because you want the A's and B's to be a bigger percentage. You want that percentage to be over 50. So all during this time of January, we were in an uptrend, and we started out at 53. And we went all the way up to 74. So that was the high of the percentage of stocks above the 200-day moving average because it is in the dark green. If you go to a day before that, you will see that the number, we were a B for the S&P, we were at A for the NASDAQ, and we were B minus for the Dow. You can see that actually we made a high in the number of A's a day after we made the high of the percentage above the 200-day moving average. The day before we made the high on the A's, we made a high on the B's, and that number came down slightly the very next day. You can see where we were in terms of the C's and D's, the lowest number that we had for the year. But actually, the lowest number that we made on the E's happened 1, 2, 3 days before we made the highest number of A's, and 1 day before we made the highest percentage above the 200-day moving average, and 2 days before we made the highest percentage of A's and B's. So we are now still in the 70s. We go down into the 60s. We're under pressure here for a period of time. That number is still going down, and now we're in the 50s. And if we pan down, you know, we're at 53, and then what happens? We go under pressure, then we go under correction. And where are we when we're under correction? We're at 40%, 47% of the stocks above the 200-day moving average. We had the highest number of C's. We had a very low number of A's, 221. And I should have highlighted that, but I did not, so my bad. And you can see that what happened was we went all the way down to 29.3% of the A's and B's. Telling you the market is definitely not strong. We continued to go down. And here we are back in April, still going down, still going down. We make a low in the percentage of stocks above the 200-day moving average at 37. We are a D plus, a B, and a D minus for the S&P, a NASDAQ, and the Dow. We have 555 A's. We have 1,059 E's, twice as much as we have A's. We are down to 37.0% of the A's and B's. That number starts to move up a little bit. You know, it's vacillating back and forth. You make a low, you retest the low, and then you either go higher or you go lower. And what happened was we, you know, fiddled around a little bit, but we did get up to 48. And actually, we went into uptrend prior to that time, mainly because the A's had already started to go up. So once we were above the 557, we made 603, we made 571, we retested at 555 and continued. You know, the market was getting stronger and we were in uptrend. The ratings for the stocks got better at C, B plus, and D. And that number was going higher in terms of the percentage above the percentage of A's and B's. So here we are back in June, and we go back into an uptrend because what happened was we are now above 50 for the percentage of stocks above the 200-day moving average. We are also at 50.8% of the A's and B's. And you can see that those numbers are much higher than they were before. We are much more than half of where we were in terms of the number of E's that were 962. Now we were only at 5 something. So, you know, things are looking much better. So we're in an uptrend in June and things are going better. But the market didn't really do as much because what happened during that time was the Dow sold off. And so we had a couple of days in here where we were in the 40s, in an uptrend. You know, the market was were also in the, and they remained in the 40s until we got to July the 12th, when we got to 52.6% of A's and B's. So what we have here is the high that we made, and that was back on July 20th. We had 1,300 A's, 3,515 B's, 1,474 C's, 942 D's, and 323 E's. The market was a B for the S&P, a C plus for the NASDAQ, and a B plus, B minus for the Dow. So those are all good numbers. We actually made a high percentage of the stocks above the 200-day moving average 2 days after that, 65, and at that time, we had already moved down to 61.5% of the stocks that were A's and B's. So we continue. We're in an uptrend for a while. We're still staying in the 50s in terms of the percentage of stocks above the 200-day moving average. We go under pressure, and we go under pressure because we are, 1,000 mark, and then we go down below that. And one of the things you see that frequently happens is you'll get down to the 400s in terms of A's. And actually, there have been times it's been lower than the 400s. And the NASDAQ, which had been the leader in terms of the year-to-date return, look at the number of days that it was an E for accumulation and distribution. All this while in here, we were under pressure and also in correction, but we were only in correction for 3 days, and then we improved because we went from 44 to 47, and then we went to 51% of the stocks above the 200-day moving average, and the numbers started to go up across the board. We're going down in terms of going up in the opposite direction from E's to C to D's to C's to B's to A's. And here on September 8th, we're under pressure again. We're only at 516 A's, so that was only 30 more A's than we made back here on August the 25th. That is not telling you that the market is strong. We should have a much higher number than that, and we are not going higher. And look where we were in terms of a little bit higher than they were before, but we're going in the wrong direction also in terms of the E's. And we were at 896 E's. On Friday, we were at 740, but I want you to remember one thing. There's a lag. So when they post these numbers, these numbers are really reflecting what happened the day before, not necessarily that day, because Friday was a really bad day, and yet the number of A's went up. It didn't really happen. The number of days went up the previous day because we were up 1% on that particular day. And then on Friday, we lost almost everything that we had made in the whole previous week. So we are clearly in the red in terms of the percentage above the 200-day moving average, and we are also under 50 in terms of where we are in terms of the percentage of A's and B's. So we have to become positive in terms of A's and B's. We were positive that one day, and as I said, we were really looking at Thursday, even though it listed it as Friday. That was Thursday's number rather than Friday's number. So we'll have to see what happens, but I still say that I am going to stick with my time frame of October the 16th is the time that we are going to be moving upward in the market, because I think we will test another low in here and then the market will take off from there. So that's all we're going to say about the ABCDEs. So let's look at the ETF table from Friday. Oh, let's see. All right. So if you look at the ETF table, and we have to go over to the left here a little bit more because there's another column that's missing. This column shows you the year-to-date change. Then we have relative strength, the accumulation distribution rating, the 52-week high. Then we have the particular ETF and then the symbol. And remember, I showed you QQQM on one of the other slides that I showed you, and it was down 2.73 for the day. And that was, some increase in volume. You never really see big increases in volume. This was an unusual one where you saw an increase in volume of 70% on the Russell growth. And that was because it was a really bad day. So, that was more heavy selling than not. If you see that they are in red, it means that there has been a loss of 2% or more for that particular ETF. And conversely, if it is blue, that one went up more than 2% for the day, at least 2%. So if we pan down, what we're going to see is we're going to see an awful lot of reds. Okay, this one is not blue, but it didn't go down nearly as much as the others, but it did go down. So we haven't seen anything that's been positive for the day. It was a really crappy day. Aha, wait. We have the short Russell 2000. It was up 26 cents. That is a 1% move, because 1% would be 23 cents. 10% would be $2.36. So it's not a 2% move, but it was a positive move for the day. So here we have the short S&P 500, and that was a positive 18 cents for the day, which was a 1% move. 1% would be 14 cents, 10% would be $1.40. Then we have the short SQQQ, and that was up 2 cents for the day, a big whopping 2%, because 10% would be $1.06. So it wouldn't be a 2%. It wouldn't be a big move, because that 1% would be 1 cent. That would be a 2% move. I take it back. Okay, and then we have the turtle short, which is SARK. It was up 44 cents. So that was a little more than 1% for the day. So if we continue to pan down, we see that we have a lot more that are negative. These are, the sectors did not do well at all, and that was because of what was happening with the rest of the market, and also what was happening in terms of the dollar. So we keep panning down and hoping we're going to see, we have two things that went up. We have the gold miners, GDX, up 61 cents, so that was more than a 2% move. We have the junior gold miners, GDXJ, which was up 88 cents, which is another 2% move. And we have the ETF junior silver miners, SILG, that was up 24 cents, which was a 2.5% move for the day. So let's pan down and see if we had any other winners for the day. Nope. Whoop. Okay, we have silver again, and that is SIVR. It was up 38 cents, which was a little more than 1.5% for the day. We have the Silver Trust, SLV, up 36 cents, which was a 1.5% move for the day. We have Tertium Wheat, WEAT, up 97 cents, which was a 1.5%, almost a 2% move for the day. Then we have the VXX, the S&P VIX, up 77 cents, which was a 3% move for the day. And then we have the Pro VIX short-term futures, the VIXY, up 76 cents for the day, which was a 3.5% move. And then none of the leverage futures, none of the leverage stocks were up. So there was not a whole lot of place that you could have made money on Friday. It was a really lousy day. So moving on, what we now have are what is called the, I don't even know what this is. Oh, these are some, these are single stock ETFs, okay? And the single stock ETFs are Tesla Long. Here's the Tesla stock. And when Tesla goes up, one of the things you find is that the percentage change for the Tesla Long, which sells at a fraction of the cost of it, has a better return. So here it is showing that it was up 21.2% as opposed to the Tesla stock going up 15.1%. The price of the Tesla stock is $274.39. The price of the Tesla Long ETF, bull 1.5 times, which is not nearly as good as a 2 or 3 times, is only $17.96. So that's a huge difference, and you certainly get a bang for your buck when you look at, what's happened in terms of the change that you get. And that change is the same for the 6 month, the 3 month. It outperformed except for this 3-month period of time when Tesla was probably not doing as well, but the Tesla down may have done better during that time. So then we have NVIDIA, we have Apple, we have Amazon, we have Microsoft, we have Google, we have Meta, we have Apple again, and some of the other stocks in here, and Alibaba is part of that group, NVIDIA long. And one of the things that you'll see here is that NVIDIA didn't do well, and the stock was down, but the ETF for the long was up more than the stock was down. So that was a good thing. And then you have the Alibaba long, and then you have the Tesla long as well, Tesla short. And the Tesla short showed that it was down 10.28% as opposed to the Tesla long up here being up 15.5%. So, it's a good way to play them. And there are 8 new single stock ETFs that just came on the market. And that should be on our next slide. Okay, so here they are. What we have are the Tesla Bear ETF, TSLQ. And this is from a different company than the Tesla one that we have now. We have the AXX 1.25 times NVIDIA Bear, NBDS. We have the 1.5 times PayPal Bear, PYPS. We have the 1.5 PayPal Bull, PYPT. We have the 2 times Nike Bear, NKEQ. This one might be something that you want to look at because Nike stock has been hit pretty heavily lately. The 2 times Nike Bull, NKEL. The 2 times PFE Bear, PFES. And the 2 times PFE Bull, PFEL. So there is a site that I am getting these from. It's called VettaFi, VETTAFI. I mentioned this a couple of months ago. It's really a paid site, but I am not paying for it. But because I worked for a financial company before, and I was able to give them some information about the company, etc., I am getting invited to seminars that they have almost daily. And I miss a lot of them, but then they record them so I could listen to the recording if I'm interested at another time. And most of them are an hour or more in length. And for those people who are investment advisors or brokers, they give them people CMEs for attending them. So moving on, we come to tidbits. So if we could make this just a little bit bigger so that I can read it, even though I have my glasses on. First thing on here we have is the auto strike. And it's interesting that all 3 manufacturers were struck at the same time. Usually they just pick one target, but they're really hitting everybody where it hurts. So if the strike lasts more than 2 weeks, layoffs will occur at multiple plants due to parts shortages. These people will collect unemployment benefits, those that are on strike. However, they are getting paid from the strike fund, and all members contribute to the strike fund. Sometimes as much as $50 a pay gets taken out of their paycheck to be put into the strike fund. However, those workers that are going to be laid off are going to be shortchanged by the union because they put money into that fund, but they're not going to get that money back because they got laid off and they were not striking. So what they're going to do is they're going to get unemployment benefits from the state. And we all pay into the unemployment benefits if we are working. So manufacturers have also invested very heavily into EV and are not in the same situation that Tesla or other manufacturers are in, as others are farther ahead in the process, and as such, they have a bigger market share. Not only of the car market, they also have a bigger market share of the products that they need to make the electric vehicles, to make those batteries that go into the electric vehicles. So EVs will require fewer workers, or there are fewer parts, and robots will have a bigger part in the assembly process. So that's why they're asking for the moon now, because at some point in time, as we convert to more electric vehicles, there's going to be less of a need for the number of workers that are working in the auto plants now. And while we may have a need for more people to service those robots, those people don't have the skills to do that. So they are going to have to hire a different type of person who has an engineering background who is going to be able to manage the robots. So I see that, while we were having the strike now, I don't see anything good coming out of it. Yes, they may get half of what they're asking for in terms of wages and benefits, but if they get everything that they're asking for, it's over $100 and some an hour with wages and benefits. I don't think anybody's worth that kind of money. CEOs make more than that, but, they're taking on a lot more responsibilities to make sure that the company is going to stay profitable and that those people who have a job are going to be paid wages for their services. So will the big three survive the EV competition? We'll just have to wait and see. So cannabis has been outperforming recently. And the reason for that is the federal government is looking into maybe removing the class 1 moniker that the marijuana has. So it's in there with things like codeine and other morphine and other class 1 drugs. And it probably doesn't really need to be in there at this point in time. So what they're basically saying is maybe marijuana is going to be legalized this time around. So we'll have to wait and see, but the cannabis stocks have been doing well. So the US dollar needs to be watched in relationship to investments, especially foreign investments. And I showed you that when we looked at the internationals and globals, etc. It's important that you watch the TBT, which is the bond. And you need to watch that on a daily basis because it reflects the inverse of the 20-year US Treasury Index. View this as a reflection of the cost of money. The higher this goes, the more challenging it is for growth stocks. It also doesn't bode well for mortgage rates, which are now above 7%, which is making it very difficult for people to buy houses, which is why you want to short the XHB, which is the builders. Most are at or below their 50-day moving average lines and could be poised to drop even lower. Oil. With the Saudis and Russia cutting through December, the price will rise to $90 or more a barrel and probably closer to $100 a barrel. And that's basically what the Saudis and Russia are hoping for. It was interesting that the Democrats kept Trump from filling the strategic reserve at $24 a barrel, but now they are willing to pay $80 a barrel to put some more oil into the strategic reserve, our tax dollars at work. Now, did we really get any benefit from all the oil that they took out of that strategic oil reserve? I wonder if it even went to any of the pumps that we have here in the United States or whether we sold that to somebody else. Student loan paybacks are starting, and that may put a further damper on retail sales as petrol prices are high. That puts a pinch on the pocketbook. So this is happening around the busy Christmas shopping season where retailers make their most money. Next year's investment, with the president election looming, media stocks, newspapers, and TV ads usually outperform in this cycle. I found some interesting stats while throwing away accumulated papers from the past, and I will present some of those at a future meeting. I couldn't believe what I had, and I still don't know why I saved most of that stuff. So new products. I thought this was really interesting. I read this yesterday. There were 361 mutual funds in 1970. By the end of 2014, there were 8,000. You got A shares, you got B shares, you got K shares, you got L shares, you got no load funds, you got load funds. You know, it goes on and on and on. That in addition to nearly 70,000 ETFs. So to put that into perspective, there were only roughly 3,700 stocks in the entire U.S. market back in the 1970s. And these funds were spread out over 900 financial firms from around the globe who compete with the U.S. market share. So since 2004, on average, 650 mutual funds have been created each year, while an average of 533 had been closed or merged with other funds. So almost as much closed as was open. Obviously, there are products that have been launched in the time that have been helpful, including ETFs, but Wall Street will continue to pump out more and more products each year with the hope that a few will work and customers will oblige by chasing hot investments. Investors should be skeptical of the majority of new investment products that hit the market unless they truly understand them and have a legitimate reason for investing in them. Which brings up a new product that is being used, and that is the one-day options. You buy them in the morning and you sell them at the end of the day. Probably riskier than other things, but I talked to somebody yesterday that has been using those, and he is willing to do a presentation at one of our meetings, and so I will get a little more information before I decide whether or not it's something that would appeal to some of our members, not everybody, and that it is not so risky that I would not want to share that with you if I thought you were going to lose your shirt investing in them. So that's all I have for today, folks. Have a good one. Bye now.